Now, for Nigeria's real estate sector in 2020, it was a year of shifts and shocks. The $30 trillion global commercial property market, for instance, was heavily tested as occupiers required less space, understanding that working from home may become the norm due to the impact of the COVID-19 pandemic. So what is in store for us in 2021? The real estate sector in Nigeria is in recession, but there is so much potential for job and wealth creation. Northcourt Real Estate has just released its 2021 Outlook report to tell us what to look out for in the new year. We're now joined by the CEO of Northcourt Real Estate, Odunsi. Good afternoon. It's good to see you.
Good afternoon, Boze. Nice to see you too.
Great. So let's look at this new report on global investment allocation by property use. Are residential and industrial property allocations the bright spots for 2021 based on their performance last year?
Yes. So what we saw is that globally, industrial was the biggest winner, right? It moved significantly from about 17% allocation to 25%. But residential remains the largest group. And though it dipped a little from 37% to 34%, what we find is that that's the case globally. When you come down to Nigeria, if we're going to create those kind of statistics for Nigeria, what we'll find is that residential was actually the biggest winner. And again, it comes down to what you just mentioned. A lot of people are now working from home. The people are carrying out multiple activities from home. Hospitality uses office, what they would ordinarily have done in the office previously. Everything is taking place from home now. And what we saw in 2020 was a lot of relocations. People relocating into bigger homes, realizing that now they need an office, they need a home office, or they need more space. Just recreate while they are in the home. So yes, residential and industrial were the two biggest winners, but residential will come tops in the Nigerian context.
So what was the impact of exchange rates, Tayo, on the real estate markets in Nigeria?
Yeah, so of course, we all know that there were significant exchange rate pressures last year, and it's continued into this new year. And this happened. This essentially has different effects on both the supply and demand sides of real estate. So on the supply side, obviously, the inputs to bringing up housing and everything for real estate, would typically be put at about 50% foreign products. That typically was higher previously, but what we found is that a lot of improvements have been made in the manufacturing sector to support the real estate market in terms of locally producing some things. So that has moved to just about 50%. And of course, it makes delivery of real estate much more expensive. But before you think that immediately infers higher cost of producing houses, what we find is that developers begin to become much more creative in ways to deliver their homes or any form of real estate at similar prices without letting the exchange rate pressures push them to increase the price per unit. They do this in terms of housing by making the units slightly smaller, intensifying the use of the land, just finding other ingenious ways, not going, selling carcass, for example, not going full throttle and allowing the end user, face the exchange rate pressures of finishing the home themselves. But on the flip side, when there are exchange rate pressures like this, what it means is that Nigerians in the diaspora, can invest more in the real estate market because their dollar goes infinitely further. And so what we typically see is that when there are these pressures, especially when the pressures just immediately start, what we find is that there's a lot of pent-up demand from Nigerians in diaspora because they believe assets have ordinarily become cheaper just, by sheer exchange rate movements.
Mm. So where do you see traffic in terms of real estate? Look at your 2020 mobility trend chart. Where do you think, what side of the market do you think there will be more traffic? Will it be retail, recreation? Will it be supermarkets? Will it be workplace traffic? Will it be residential?
So that was an interesting tool to use, right? That's a tool that's made available by Google, essentially just using the GPS functions on all of our phones to track where we are. One way or the other, Google tends to know that I'm currently in my office, and they probably know you are in yours as well. So essentially, what this then does is that it's able to just track where we are, because if I move from my office to the nearest supermarket, that location is already pinned as a supermarket and it's already pinned as retail. And so that's essentially the methodology of just doing this tracking. And what we saw, is that all through the year, as it's intuitive, most of us were at home. And so the biggest user, so that's how we in real estate can use this tool, is to know where people spend most of their time. So in 2020, I mean, it's no prophecy that people spend most of their time at home. I recall there was a report that we did last year, after the NSAS protest, and we could see from this mobility tracking that about 90-something% of people just stayed at home. They weren't on the streets protesting.
So you knew where I was last year.
Well, I didn't know where you were in particular, but the aggregates, I could see the aggregates, right? Just looking at this tool, it's a very interesting tool. And just to come back to your question, where do we think people will be moving to? Where are the places people will be going to?
Yes.
And this ties neatly to our outlook for the year. And we've pretty much taken three positions, right? And it's scenario based. What we've said is that if in 2021, Nigerian economy improves, right, there'll be significant growth in the commercial real estate market. And that's quite intuitive to say, because there is currently pent-up demand, essentially for retail, for hospitality, and even for people to come back to their offices and work and hug their friends as they used to. Of course, for that growth to take place, there has to be both economic, surpluses, and also we have to win on the pandemic front. So that's the first scenario. The second scenario is if things remain as they are, and essentially residential will continue to be the winner in that scenario, because people will continue to stay at home, and that's where people will do their work from, and people will just have to go to their penthouse or something to do some form of recreation, because movement is essentially limited, especially with the second wave. The third scenario is if there's a decline. What we envisage is just looking back at the past recessions that we've had and looking at the data that we have gathered. We found that in such scenarios, land as a real estate asset class, land banking as a real estate asset sub-market essentially wins in recessionary times. It's this way because land has no repayment pressures. People typically don't buy land with debt; they buy to equity, and so they are cool enough, to say this is the kind of profits that I want on my land. And so in those kind of scenarios, land will be the winner in terms of sub-markets. We envisage that the first two scenarios hopefully are more likely. That is a case of things staying as it is, and then residential being where we will all be, or in the case that by Q2, Q3, there can be some economic wins, and then the pent-up demand that we're seeing for commercial activities in terms of retail, people going back to the office, will then be the order of the day.
Tayo, how do we get more PFAs, pension funds, into the real estate market? 6.3 trillion naira last year for PFAs in FGN retails, treasuries and bonds. Real estate, 230 billion. How do you have any idea how to attract more into your sector?
Yes, I remember back in the day, I used to look at this chart and get upset that PFAs, are not investing enough in real estate. But come to think about it, I think it's for your good and mine. All right. Real estate, to be honest, I'll be the first to say it's quite a risky asset. And the legislation or the policy in place that PFAs can only come into real estate indirectly, I think it's fine, and I think it can stand. But we need to look at history, right? There has been a few equity indirect real estate products put on the market, and they've not been the most successful. All right. I wouldn't want to mention names, but the equity real estate products have not done well. And these are the kind of products that pension funds ordinarily can put money into. But on the flip side, the debt instruments, bond issuances that real estate companies have put on the market, you see, there's a pressure that debt puts both on real estate companies and any type of company, to be honest, is that they are the obligor of first choice. They are the ones that get paid first. And those products have done better. I would say that for the state of maturity of our market, for PFAs to come in, we need to see more of this sort of debt instruments that PFAs can then subscribe and put on their books. Once developers, investors begin to structure those kind of products, I think this conversation of we just attracting a pittance of the pension fund share will be a story of the past. And once we are doing well on that front, I think we can then begin to look at what are the lessons we can learn from doing debt instruments, and can we do convertible instruments where there's both an equity and a debt portion, and then we'll now start doing full-on equity instruments that PFAs can subscribe to.
Hi, Odunsi, thank you so much for your time this afternoon. Great insight from you from the real estate sector. Thank you, and see you some other time.